I had an interesting discussion a few days ago with a couple of guys who are in my age range, and the discussion was centered around whether it would be better for us to be investing in tax deferred 401k or the traditional 401k or the Roth 401k. So that was the discussion. And it's not the first time we've talked about that. There are all kinds of opinions out there about which is best. And, mind you, for most of my career, I didn't have a Roth 401k available. So everything was in tax deferred. As a result, most of the assets I have are in tax deferred or traditional accounts, whether it be 401k or IRA. So that was the kind of discussion / debate that we had. And personally, I've kind of come full circle on this. One time I was heavy into, I got to catch up, and I got to really try to catch up on my Roth contributions, like I said, because most of my career Roth 401ks weren't available. So I started trying to do some of that. And then as I continue to read and research and study, and all kinds of people have all kinds of opinions about what is best, and I started to feel a little differently. And now I'm of the opinion that most people, when they're in their, let's say mid to end career, are still gonna be better off if they contribute to a traditional 401k. Now, that's not all. I said most people. And I'll tell you why I think that's the case. Because when you're working and you're contributing to a 401k, you are contributing at your marginal tax bracket level. Your marginal tax rate, also known as how you will be taxed on the very next dollar that you earn. So when you're working, that's how you're taxed. And it may be 10%, 12%, 22%, 24%. I think you get 37%, so forth and so on. So that is how you're taxed when you are working. But when you retire and you no longer have a job, you are taxed at your effective tax rate, which almost all the time is going to be less than your marginal tax rate. Because think about this: when you retire, you're going to have when you do what you call fill up tax brackets. You likely don't have as much taxable income as you did when you had a job. So when you start taking money out, when you take money out of your tax deferred accounts, you start filling up your lower tax brackets first. So like today, you start at zero, then you go 10% tax bracket, 12% tax bracket. I can't remember, 22%, 24%, 27%, whatever the tax brackets are now. Don't have that committed to memory, quite honestly. But when you retire, you start taking money out of your traditional or your tax deferred accounts. You are starting to fill up those low tax brackets first, 10%, 12%, and so forth and so on. But here's the big thing. When you take money out of your tax deferred account, whether it be traditional 401ks or IRAs, that's treated as taxable or ordinary income. So you also get a standard deduction. And today, for a married couple, you have a standard deduction. I think it's $29,200. So almost $30,000 standard deduction for a married couple filing jointly. So that essentially means you can get $30,000 out of those tax deferred accounts and pay zero taxes. So think about that. You start out with a standard deduction of $30,000 before you even start getting taxed on that income. So when you consider that, and the rate that you're being taxed at right now while you're working, I'm not as concerned as I once was about whether I'm contributing to Roth or traditional. That's just one less thing I'm concerned about as I move closer and closer to the day where I can hang them up. So I was just thinking about that today, and it kind of lifted a load off of me, because it may even be a situation where I pay the same amount of taxes while I'm working as I do when I retire. That'll be fine too. In other words, it just takes a little bit of a load, reduces one of the concerns that I've had, for a little while. Not a major concern, but just one of those things you want to consider as you're doing planning for retirement. So anyway, maybe that'll make you feel a little better too, because it definitely made me feel a little bit better, because that's just one of those things that there's a lot of discussion about. A lot of people have varying opinions about, and I don't know if there's a right or wrong answer in most cases. And I always say those are first world problems. If you've done the work and you've in some ways even delayed gratification, and you get to that point where you can now live off the fruit of your labor, there's no need to be overly concerned about how much taxes are going to impact you, because you've done the work on the front end, and there are varying ways to minimize the amount of taxes that you pay once you get to the point where you're retired and enjoying your life, and again, as I said, living off the fruit of your labor. So hope that makes sense to you guys. Kind of lifted the weight off of me. Now I can think about something else besides that. So if that helps you, then that's a good thing also. God bless.